Today, we are diving into one of the biggest financial policy shifts in a recent history. US President Trump is set to sign an executive order that would change how millions of Americans invest for retirement. For the first time in history, the retirement accounts might soon become eligible to invest into private assets such as private equity, private credit, real estate, crypto, and so on. So, what does this mean for your retirement account, how you can benefit, and how you can make allocation in your portfolio? And that we will discuss in this video. So, stay tuned. So, the number one question is, what are actually alternative assets? Let's break down each of the alternative assets so we can understand better. Number one is a real estate. What are the characteristics of real estate? It is hard asset backed, it is income generating, it has a potential for upside, and it has a low correlation with the public market. And these are the exact reasons because of which institutional investors and individual investors prefer to invest into real estate. Number two is the infrastructure. So first we have to understand what are infrastructure assets. The infrastructure assets example is power plants, road, railway, airports, hydropower plants, and so on. Now, infrastructure assets have all the characteristics of real estate, but they also have additional characteristics such as they are very resilient asset class. Why? Because the contract of the asset is long term and they are also linked to the inflation. Also, the barrier to entry into infrastructure asset is very high because of the requirement of huge capital to invest to build this asset. Number third asset class, which I'm sure you are very familiar with, is private equity. So the reason private equity is become a darling of investors because private equity gives higher return over the medium and long term as compared to the stock market. Private equity returns are also very less volatile and private equity is illiquid. Number fourth asset class is called credit. So credit is an asset class that has become quite popular recently among the investors, and the reason is because it has low risk, it has low volatility, and it has low interest rate risk because most of these private credit actually are floating rate assets. So these are rates which are adjusted according to the interest rate change. Now, I'm not gonna go more into detail about the hedge fund and crypto. If you wanna know the characteristics, you can pause the video and look at it. Now you know the characteristics of these asset classes and the reasons because of which institutional investors prefer to invest into these asset classes. I will tell you in this section how you can basically invest into these asset classes. Now you have to understand that you will not be able to directly invest into private assets, rather you will be investing into these assets through funds. So in this section, I'm gonna discuss about different types of fund. And I'm sure after understanding different types of funds, you will become mini financial advisor to understand whether or not to invest into each fund. Now, first just look at the liquid fund, which is the most common and the most popular among the individual investors. What is liquid fund? So as the name indicates, liquid fund, these are very liquid in nature. And the most famous example is ETFs. Now let's just take an example of ETF in the case of liquid fund. Now you know you can buy ETF anytime as long as the market is open, and you can also sell the ETF whenever you want. There is no holding restriction. There is a very high level of price transparency, which means you can see the trading price of ETF at any time. And the fee, the fee of the ETF are actually very moderate. It could be from certain bips to a certain percentage point, could be maximum 2, 3 or 4%. And now we will discuss about the types of funds through which you will be eligible to invest into private assets. Number one is semi-liquid fund. So as the name suggests, semi-liquid funds are the funds which are semi-liquid in nature. So what does this mean? This means once you invest your money into semi-liquid funds, there is going to be a lockup period. It could be few months or it could be 1 to 2 years. The second thing you have to understand that once you apply for the redemption from the fund, it could be after a specific interval of time. It could be at the end of the month, it could be after the end of the quarter, or it could be biannual. Third thing you have to keep in mind, there could be a redemption gate. What is redemption gate? So let's just say you invested $1,000 into semi-liquid funds, and after the completion of lockup period, you want to withdraw your entire investment of $1,000. So as per the regulations of fund, you might not be able to withdraw your full $1,000 into one quarter or into one period. Why? Because there is a redemption gate and you will be only be able to withdraw to a limit being imposed by the fund. It could be 20%, it could be 30%, or it could be 50% during a month, during a quarter, during a biannual, based on the prospectus of fund. Now, let me give you an example what I'm saying. Back in 2022, Blackstone has a famous fund of Blackstone Real Estate Investment Trust, which was a whopping $69 billion of assets under management at that time, and they receive a whole lot of redemption requests. So what did the Blackstone did to control the leakage from the fund? Simple. What they did is that they basically applied the gate and they limit the redemption requests from the investors. So that means even if you are invested into semi-liquid funds, your full redemption will be not in control of you, but rather is going to be controlled by the fund manager. Another important thing you have to keep that in mind is the price transparency. Like, what is the value of your investment into semi-liquid fund? In the case of liquid funds such as ETF, you know exactly what the price is of the ETF or other financial asset. But in the case of semi-liquid asset, it's not going to be readily available. It could be available by the end of the month, by the end of the quarter, or by the end of biannual. Depends on the investment prospectus of the fund. Fee is another important point that you have to consider into semi-liquid fund. The fee could be moderate to high based on the type of underlying asset. If it's a private equity or if it's a VC, then the price could be extremely high. Or if it's a private credit diversified, then the price will be low. Now we'll discuss about illiquid funds. So as the name suggests, illiquid funds are the funds which are completely illiquid in nature. And the best example of illiquid funds are the private equity funds, real estate funds, and the venture capital funds. There's going to be a long lockup period. It could be 5 years, it could be 7 years, or it could be 10 years, depending on the investment strategy and the prospectus of the fund. You also have to keep that in mind that there's going to be a no redemption in the case of illiquid funds. If you want to redeem, you have to find another buyer who is willing to buy your stake, which is very rare in the case of illiquid funds. You also have to keep that in mind that the price transparency in the illiquid funds is very low. So the value of your investment will only be available either on a quarterly basis, biannual basis, or an annual basis. Illiquid funds are usually comprised of private equity, real estate, venture capital, which offer a higher return, but they could also come up with the high risk. Now the fun part, which is the fee. The illiquid funds could charge different kind of fee. It will be management fee, it will be performance fee, it will be upfront fee, it could be any other fee which you have never heard. So that's why it is very important to read the fee section of the prospectus of the fund before you invest into illiquid fund. Now that you have learned about the characteristics of private assets and different vehicles through which you can invest into private assets, the big question is, should you invest your retirement money into these private assets? In my view, if you are a beginner or conservative investor, keep your overall portfolio into assets which are broad, diversified, offer stable return and low volatility, and you should not invest into private assets into no more than 10 to 15% of your overall portfolio. If you like the video, please hit the subscribe and the like button.